Welcome back to Global Value. In today's video, we're going to be taking a look at Amazon.com, ticker symbol AMZN. So Amazon, as I'm sure everyone knows, is one of the largest companies in the world. It's been a stock market darling, especially since its more than 97% fall during the 2001 dot-com bubble crash. Amazon is an absolute monster of a business. However, it's down 31% over the past year. We'll be performing a fundamental stock analysis of Amazon. Through this analysis, we're ultimately going to come to a starting point about how to think about Amazon based on its financials, and try to determine, does this recent downturn in Amazon's stock price maybe give us a buying opportunity for Amazon the business? So at the time of recording this video, Amazon is trading for just over $2,200 per share. As I mentioned, they're down 31% over the past year. Even with that drawdown over the past 10 years, they've still returned about 27% compounded annually, which is far and away beating the S&P 500. So scrolling down, we can see that Amazon is about $1,500 off of its 52-week high, and Amazon is a huge company. Their market cap is a little over $1.15 trillion, so just enormous. For some background about the business, Amazon Inc. engages in the retail sale of consumer products and subscriptions in North America and internationally. The company operates through three segments: North America, International, and Amazon Web Services. Amazon is a leading online retailer and one of the highest grossing e-commerce aggregators with $386 billion in net sales and approximately $578 billion in estimated physical and digital online gross merchandise volume, or GMV, last year. Retail-related revenue represents approximately 80% of the total revenue, followed by Amazon Web Services, cloud computing, storage, database, and other offerings, which are about 10 to 15% of revenue. Advertising services makes up 5% of revenue, and any remainder comes from Amazon's other businesses. International segments constitute 25 to 30% of Amazon's non-AWS sales, led by Germany, the United Kingdom, and Japan. The company serves consumers, sellers, developers, enterprises, and content creators. Amazon.com was founded and incorporated in 1994 by Jeff Bezos and is headquartered in Seattle, Washington. So one fun fact about Amazon is that although most of their revenue comes from their core online e-commerce, the majority of their profits actually come from their Amazon Web Services, or AWS division. So with that short background, let's get right into our fundamental analysis. We'll be performing an 8-pillar analysis as popularized by Everything Money to give us a starting point of how to think about Amazon as a business. Starting off with pillar number 1, we want their average 5-year PE to be below 22.5. Currently, they're trading at a 53 PE, and over the past 5 years, they've averaged a 121 PE. So pillar 1 is an X to start off. Pillar number 2, we want to see their average 5-year return on capital be above 9%. So Amazon does a good job of earning above average returns on capital. They average out at about 10.5% over these last 5 years. So that's our first check on pillar number 2. Next up, pillar number 3, we want to see 5-year revenue growth. And this comes as no surprise that Amazon has blown this out of the water. They've nearly tripled revenues over the last 5 years. Scrolling down on their income statement, looking at pillar number 4, we want to see net income growth. In 2017, they had about $3 billion of net income, and they grew that all the way to $33 billion of net income in 2021. So that's a check on both pillars 3 and 4. Huge growth coming out of Amazon. It's hard to believe that such a big company is growing at such high rates. Pillar number 5, we don't want a business to be diluting existing shareholders. And here we can see that Amazon has slightly increased its shares outstanding over the last 5 years. They've increased this from about 493 million shares outstanding in 2017 to 515 in 2021. So not bad, only slight dilution. This is definitely not out of the ordinary for high growth companies. A lot of times these businesses are going to use shares both as an incentive for employees as well as for some of their acquisitions. So this is just slight dilution. They more than make up for it in their revenue and net income growth. However, ideally, we don't want a business to be issuing new shares as it ultimately dilutes your ownership percentage of the business. So that's an X on pillar number 5. So far, we have 3 checks and 2 X's. Next up for pillar number 6, we want to see 5-year free cash flow growth. So free cash flow is cash from operations minus capital expenditures. It's this green column here. So in 2017, they had $6.4 billion of free cash flow. And as we can see, especially since the pandemic started, Amazon has devoted a ton of capital to capital expenditures. So this led them to have negative $15 billion of free cash flow in 2021. And we can see that they've nearly 6x'd their capital expenditures in the last 5 years. From 2017 to 2018, they had a slight uptick of a couple $billion each year. And then that really took off starting in 2020, and they really invested a ton in 2021. Part of Amazon that's a little different from some of the other tech businesses is obviously they have a huge infrastructure and logistics network for their core e-commerce, as they're handling most of the shipping and the logistics themselves in-house. They also have to spend a lot on CapEx for their Amazon Web Services business between their data centers and the servers that are actually used there. Part of understanding the business in more depth is really understanding what their capital expenditures are fully going toward and how these align with their long-term goals to hopefully widen their moat and provide more customer value over time. Amazon's very famous for having a customer-centric approach and thinking very long-term about their business operations. So it's not too much of a surprise to see that they've really scaled up capital expenditure to meet this huge influx of demand caused by the pandemic. Although that's an X on pillar number 6, that's not too worrisome because we can see that their cash from operations has steadily increased. Also, averaged out over the last 5 years, even with this negative $15 billion of free cash flow last year, Amazon still averages about $11.3 billion of free cash flow each year. So we'll use that number in pillar 7 and 8. Next, for pillar number 7, we want Amazon's net debt, which is long and short-term liabilities minus cash and equivalents, to be below their average 5-year free cash flow multiplied by 5. Currently, Amazon has about $43 billion of net debt, and if we multiply their $11.3 billion of free cash flow times 5, that brings us to $56 billion of free cash flow. So that's a check on pillar number 7. If their next 5 years are like their last 5 in terms of their free cash flow profile, Amazon will produce plenty of cash to pay off all their debts. So that's a sign of a strong cash flowing business. Finally, pillar number 8, the big pillar of them all, we want Amazon's market cap to be below their average 5-year free cash flow multiplied by 20. So Amazon, as I mentioned, is one of the largest businesses in the world. They have a market cap of $1.15 trillion. So multiplying their average 5-year free cash flow of $11.3 billion times 20 only brings us to $226 billion. So that's a solid X on pillar number 8. So 20 is just a starting point, but even with that, their free cash flow profile is significantly off from their market cap. So it's difficult to see any sort of margin of safety here based on those free cash flow numbers. The real margin of safety that would come from a business like Amazon is going to be its moat, which consists of its customer lock-in both on e-commerce through something like Amazon Prime and AWS as their infrastructure and platform as a service over a really long period of time, both of which hopefully contribute to their lock-in, as well as by focusing on their customers allows them to maintain pricing power over the long run. In summary, Amazon checks the box on 4 out of 8 pillars. It's a very strong, highly growing business, but it looks richly priced. So it's tough to see a margin of safety just by looking at the financials of the business. However, that doesn't necessarily mean that there isn't one present if the business is of sufficient quality. So to really figure that out and learn more about the quality of the business as well as Amazon's long-term trajectory, I highly recommend going back and reading through their annual reports. Also, there are a number of books written about Amazon, including The Everything Store, as well as a recent book by Walter Isaacson, notating some of Jeff Bezos' writings in Amazon's annual reports. A second fun fact about Amazon is that every time they release an annual report, they attach their very first annual report that Jeff Bezos wrote to shareholders in the 90s, which includes three things: a customer-centric focus, a view of the business that's completely focused on the long run, and the mentality that it's day one in terms of delivering value to both customers and shareholders. So those are, three key tenets of long-term success for a business, and three things to keep in mind as we're looking at how Amazon is going to progress into the future. Well, guys, that's it for today's fundamental stock analysis of Amazon.com, ticker symbol AMZN. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about Amazon, and have a great day.